There are elements of research kind of worked in there, but I'm going to sort of try to build up to that as we go along. This is not a class that I'm teaching you all, so there are many things that I'm going to kind of go through quickly and say, okay, Modigliani and Miller, we all know that, and blah, 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 this sort of thing. But feel free to ask questions at any time, slow me down. So, here we'll be talking to the students, how do companies choose optimal capital structure, and I'm going to talk to them about first corporate taxes, personal taxes, talk about cost of debt, agency costs, bankruptcy costs, and do this all kind of in the context of a trade-off theory, pecking order theory, as well as CFO survey evidence. I'm going to try to kind of interweave all those things. And if we can get this thing working on the other computer and hook it up towards the end of the talk, much of what I'm going to build up to, we can actually do in a little Excel spreadsheet. So the students kind of love that because it sort of validates, oh, that stuff the professor was showing us actually, I could actually use that on the job to some extent. So I'm going to start with Modigliani and Miller. Now again, I'm not going to try to go through the same wording I would use with the students, and I've cut out some of the slides, but nonetheless I'm going to click through many quickly. The point here, of course, is in the perfect world, we'll talk about what the assumptions are that lead to the perfect world, whether they're realistic, what's the advantage of talking about a perfect world and all that. But ultimately, the bottom line conclusion is that it doesn't matter whether you have debt or not, the size of the pie doesn't change, right? So value can't be created or destroyed in the perfect world because of capital structure choices. So even if the equity holder was to issue debt, the debt holder will pay in the $25 in this example. In principle, the equity holder will put that in their pocket and still own $75 worth of the firm. So overall, the equity holder's value, the total value of the firm doesn't change. Even in that world, it's important to kind of get the concept across that equity still becomes riskier as you use more debt, right? So as you use more debt, the cost of equity here is going to go up. And the weighted average cost of capital, as the company adds some of this cheap debt, the equity is going to go up in a way that just exactly offsets the increased use of debt, so the weighted average cost of capital line stays flat. And there's a formula up there, the kind of the levering formula for the cost of equity that is important for them to understand. If you use debt, you add financial risk, higher return, but you don't actually reduce your weighted average cost of capital. Down on the bottom, there's the beta version of the formula. And then down here in the corner, I like to show them, you know what, later we're going to add corporate taxes very soon. And when we do, it's really the same formula, but we just have a tax term in there. In other words, the tax rate's just 0 in what we did so far. Okay, so normally that would take longer with the students, but now we're going to add corporate taxes. So we'll add the one imperfection. Now, it's not just adding corporate taxes that matters, it's adding interest deductibility, right? So there's been talk of Congress eliminating interest deductibility for US companies. If they did, then we could just stop where we were already with the previous formula. So you need interest deductibility, although we don't always remember to say it that way. Well now, again, I'm not going to go through all the bullet points, but now when we add, what happens is, in this example, the government, we're saying, is a 25% tax rate. So the upper left corner there, corporate taxes, the government's taking 1/4 of the value of the firm away. Now when the company decides to issue debt, because debt interest is tax deductible, relative to using all equity, now they actually save on their tax bill. So the slice of the pie, that gray area, attributable, that goes to the government, gets smaller. And therefore, if the government's taking less, what's left over for investors gets bigger. And in this example, this numerical example, TC times D is kind of the magic formula we're going to use. I would kind of work towards deriving that with the students, but I know you guys all know the formula, so I won't. But it actually saves them, out of the $25 in taxes, $6.25. So that's $6.25 less to the government, and that ends up flowing right to the equity holders, okay? The bondholders still pay in their $25, equity holders reduce taxes owed to the government, and that increases what's left over for investors. So that's kind of the good news of the corporate taxes when we're ignoring all costs still. There's the formula again, the simple formula when we have perpetual debt, the D is perpetual debt, just multiply that times the corporate tax rate, it tells us how much value would be added just from the corporate tax savings, ignoring all costs. So I'd like to use this example from Michael's LBO. Michael's is arts and crafts store. It was worth $4.5 billion before they had any debt. So the value of the unlevered firm here was $4.5 billion, and they came out and said, we want to sell ourselves for more than $4.5 billion. And you can kind of go back and see the Wall Street Journal article and let the students read it. In the end, they sold themselves for $6 billion, so a $1.5 billion premium. And guess what? They used $4 billion worth of debt. So TC times D is equal to roughly $1.5 billion, which was the premium they sold themselves for. Now, you have to admit to the students, this is probably not perpetual debt. They probably won't maintain that high level. There are costs that work against using a lot of debt. But still, the point is it kind of hammers home to the students that it's a handy formula to have, at least back in the envelope, to do some quick and dirty calculations. What I've found with MBA students, and with undergrads when I've taught them also, what they seem to care the most about is this have any relevance to me on my job, or my professional life, or even in my personal life? Once you convince them that it does, then they're going to perk up and kind of learn it. And so when you can kind of bring it to the real world examples, I've found that quite helpful. Now, if you want to get a little bit international on the topic, the TC times D gets complicated when you have dividend imputation. What that is when the government gives you credit, the company credit for taxes they pay, they can actually pass that credit along to their dividend receiving investors, okay? It basically makes dividends tax deductible or partially so. So here's the formula you could use. If the dividend imputation rate was half of the corporate rate, let's say the corporate rate's 35 and the imputation 17.5, plug it into this formula and you'll find out there's still a tax advantage to using debt relative to using all equity, but it's smaller. You might not want to go there, I realize when you're teaching your students, but it is something that kind of gives a little international flavor. Depending on your student body or where their companies operate, it can be helpful. And here's a list of some OECD countries that either currently have dividend imputation or at least in the last decade have experimented with it. So those are some big well-known economies that it's kind of worth recognizing that the TC times D formula doesn't work exactly right in those environments. All right, so then I'd like to put up this picture. It's a simple little summary of what we've done so far. The value of the unlevered firm when they use no debt is just this number right here. As we use more debt, the value goes up linearly with the amount of debt, and the TC, the slope of that line, is just the corporate tax rate. Let's call it 35%, okay, the US corporate tax rate. What you can see from that immediately is use as much debt as you can, basically, when there's no cost, because value keeps going up and up and up. So as you're going to see later, why I kind of like, that picture's pretty simple, but it's kind of good to get it out there now as we kind of build. You could also put up a lower tax rate situation, maybe a company with a lower tax rate. They're still going to want to use as much debt, but each dollar of debt is actually producing less value for them. So kind of the tax benefit of using debt obviously goes down as the tax rate goes down. Real world example, right now Congress and President Obama are talking about lowering the corporate income tax rate to 25%. Even in kind of ignoring costs, that's going to reduce the incentive to use debt, or at least reduce the value contributed by using debt. So why might you have a lower tax rate? Well, in a progressive tax schedule, you might just have a smaller company that has a lower tax rate, lower income, therefore a lower tax rate. You could also have the effect of personal taxes, which we'll talk about next, can lower kind of the effective tax benefit of using debt, or probability of loss. And that's going to build up into some more interesting things. If this company here has a 1/3 chance of loss and only a 2/3 chance of being profitable and paying taxes, ignoring tax loss carryforwards and carrybacks, multiply 2/3 times the tax rate, they're going to have an effectively lower tax rate, therefore less tax advantage of using debt. All right, this picture then comes back into play, similar to what we had before. But if you remember before, the weighted average cost of capital doesn't change in the perfect world. Now when we have tax deductibility, the weighted average cost of capital will fall as we use more debt. Now why is that the case? Well now, rather than RD being what we add into our weighted average cost of capital, so here's the weighted average cost of capital formula. Rather than it just being RD, now it's the after-tax interest rate. So we account for tax deductibility here by multiplying by 1 minus the tax rate, okay? And so now when we're doing our weighted average, we're actually weighting in this line here, which is cost of debt times 1 minus TC, all right? Now when we take our weighted average, yes, we do bring in more of this expensive equity. Yes, the cost of equity still goes up as we add more debt, but the cheapness of debt is so much cheaper that the weighted average cost of capital falls now. Why is debt cheaper? It's only because of interest deductibility, right? If the government took that away, then this picture would no longer hold. Now, here's the levering formula. It's the exact same before, but we have this term now that accounts for tax deductibility, interest tax deductibility. Actually, in the notes, I didn't include them here, but I'll actually sort of derive these formulas. Well, I used to derive it. Now I just have the pages of notes. If you just start with a balance sheet that has debt and equity on one side, valued unlevered firm, and tax benefits on the other, and do some algebra, you derive the weighted average cost of capital formula, the levering formula, even this shortcut weighted average cost of capital formula. That's the one straight out of Modigliani Miller. All these things. So it's nice, I think, to kind of tell the students that this is not, we're not just making these formulas up, they're grounded in actually something that's pretty simple, but you just have to do some algebra to get where you're going. So cost of equity still goes up, but at a lesser rate once we have interest tax deductibility. All right, I said a minute ago, we had the two lines. How can you have a lower corporate tax rate? Here's just the numerical example of what I said out loud a minute ago. If you have two companies, the one up top here is the profitable company, okay? And there's a 1/2 chance they're going to be profitable, 1/2 chance not. If they're profitable, they make $3 million and they pay a 35% or 40% tax rate, I guess, in this example. If they're unprofitable, they're losing money and they pay a 0 tax rate. Figure out the tax rate on each branch of the tree and take the weighted average and expected value. Tax rate would be 20%. So you don't want to take the expected income and take a tax rate off that. You want to figure out the tax rate on each branch and take the expected tax rate. How about this company that's more profitable? 3/4 chance of being profitable, 1/4 unprofitable. Well, do the weighted average, their tax rate is higher. So in other words, higher probability of loss is going to have a lower expected tax rate, just to kind of put some numbers on that picture that I showed just a minute ago. All right, so next thing is just a bit related to what we just talked about there. Companies can actually self-inflict becoming unprofitable. How? By getting a whole bunch of deductions. One way you get a bunch of deductions is by using a lot of debt and having interest deductions, right? So we've got 3 companies now, and these 3 companies, the one on the top has a 1/3 chance of being quite profitable and having a $3 million of income. The one in the middle has a 1/3 probability. I'm going totally old school here. I found my pointer here. The middle 1/3 probability of making $1 million and a 1/3 probability of losing money. So their expected tax rate is going to be 2/3 times the 40% tax rate if they're profitable, plus 1/3, or that would be 26%, would be their expected tax rate. So take that company, and let's say they issue debt to the tune of $2 million worth of interest per year. So they issue however much debt, it takes $2 million. That's going to lower their taxable income in every scenario, because you're taking interest deductions in every scenario. So rather than $3 million, they're down to $1 million of profit in the good scenario. Now they're going to have a $1 million loss in the middle scenario and a bigger loss in the bottom scenario. So now their expected tax rate is 1/3 times 40 plus 2/3 times 0. It falls down to 13%, right? Now let's say they take on another $2 million worth of interest. Now they're not profitable at all. So if they take on enough debt, they become totally not profitable in every scenario. Their tax rate is effectively 0. I'm ignoring like being able to carry losses forward and such, okay? So here's the picture of that I should have labeled this axis. When they had no interest, their tax rate's 26%. When they had $2,000 in interest, their tax rate is 13%, and when they have no interest, their tax rate is all the way down to 0. Now, the reason I want to draw this is because in a little bit, I'm going to talk about a declining marginal benefit of using debt. And here we've got the numerical example. As you use more debt, remember we said the way you measure the benefit of debt is this kind of TC times D type thing? Well, as TC goes down, the value of the next tranche of debt declines. So by using interest, the company is experiencing a declining marginal benefit for the next tranche of debt that they might use, all right? So this is the declining marginal benefit. And when we talk about both benefits and costs, I want the students to go, oh yeah, I've seen that. We did a simple example. I'm comfortable with that picture, all right? That's kind of the straightforward or simpler way to do it. Now, I don't actually recommend you probably do this part, but I do this because this is kind of close to my own research. So well, let's put it this way. If you decide to adopt any elements of what we're talking about today, go for it. This would be kind of the last one I'd probably adopt if I were you. You can actually redo all this stuff with considering tax loss carryforwards and carrybacks, right? I mean, students claim they want to learn things that are closer to what they would actually do on the job. You get on the job, that's a realistic thing, tax loss carryforwards and carrybacks. Okay, students, so I actually spend a little time on this. Again, you might not want to, but we're going to get to the same point. I'm going to really go through this again quickly, not to try to spend a lot of time explaining it as much as just let you know, here's one thing you could do. So a tax loss carryback, what that means in the United States right now, tax law is if you have a loss today, you can carry it backwards and get a refund for taxes paid in the previous 2 years, all right? That's what a carryback is. Or in the US, you can carry a loss forward for up to 20 years. So if you have a huge loss today, you can carry it forward and shield income. You might not pay taxes again for like 5 years, or if you're GM, for 10, 12 years or whatever, okay? What that means is any incremental income that you happen to earn today, you're not going to actually pay tax on it now because you're not going to pay taxes for 10 or 12 years, let's say. You're not going to pay till way out in the future. And the present value of the tax you pay then is actually fairly small today for that incremental income, okay? So that's the US rules, and again, just to make sure students realize the rules aren't the same. One, the rules aren't the same everywhere, but two, this is not just something that only applies to the United States. It applies across many, many countries. There's some other countries' information down there. Whoops. And then again, I'm going to click through quickly here, but I'm going to just show them that when you have it, to hit the point home, when you have a $5,000 loss, what that means is you'll carry it forward and not have to pay tax at all on the $3,000 in profit next year. And you'll have $2,000 left over to carry it forward and shield 2/3 of that to only have to pay tax on $1,000. I mean, that's what we mean by a carry forward. And you can do the same thing with carry back, and I kind of deleted some of the notes. All right, so now we want to talk about a marginal tax rate. What a marginal tax rate is, I earn an extra $1 today. What do I pay tax on that dollar? And remember, I might not pay tax on it for 4 or 5 years in the future because of these loss carryforwards and carrybacks. So there's a simple example. I'll kind of show the more complicated. That right there is just a repeat of what we just did. If you have this loss, you're going to carry forward $3,000 one year and then $2,000 the second year. To measure a marginal tax rate, what that means is you earn $1 extra here in year 0. So rather than having a $5,000 loss, you earn an extra $1. Your loss drops down to $4,999. So I still carry $3,000 forward and don't pay any tax there. But now I can only carry $1,999 loss forward into year 2. What that means is because I earned an extra $1 here, I pay an extra 40 cents in tax in year 2. Well, what's the present value of taxes paid out in year 2? It's just this divided by 1 plus r squared. It's a number less than 40%. It's 33%. So because I had carry forwards, the loss carry forwards, it delays when I pay tax. It lowers my effective tax rate. Now, by the way, I know I'm going fast. So for some of you, this is probably simple. For other of you who've never thought about it, it might be, why is he going so fast? I'm not really trying to take the time to grind through it in excruciating detail here. So I want to show you kind of the flavor. Later on, I'm going to slow it down a little bit and talk about some of the other stuff in a little more detail. All right, so this company, remember, lost $5,000 in year 0 and then made $3,000, $3,000, $3,000. Well, now I can go back through that same experiment before. Let's say I took on debt that was such that I had a deduction of $1,000 every year. That's how much, that's interest deduction. So the negative $5,000, I self-inflict a loss. It turns into negative $6,000. The other numbers each get 1,000 smaller too because I'm taking the deduction, right? So that's the ugly version of this. All I did was cross off the numbers that I had, and I made them each 1,000 smaller because I'm taking $1,000 worth of interest deduction. Because that's kind of hard to look at, I'm going to redo it on the next slide without the blue lines and everything. So this is the same numbers as before, and the only difference is now I've taken this $1,000 worth of interest. What that means is I made my loss bigger. Therefore, when I carry it forward, I'm going to carry it forward kind of further, ultimately, is what happens. It's going to push off further into the future when I eventually pay tax on an extra dollar today. It's going to end up reducing my marginal tax rate. So with $1,000 worth of interest, now, rather than in year 2, I don't pay tax on that extra dollar until year 3. Take a present value of that. Now, rather than 33%, it fell to 30%. Okay? Again, I know I'm going fast, but $2,000 worth of interest, that means just take another $1,000 off each year, make the loss even bigger, and also make these other incomes smaller. So now that loss, I can keep carrying it forward all the way now out to year 4. So earning an extra dollar today, I wouldn't pay tax on it until year 4. So as I take more interest, I make my loss bigger, or the probability of the loss bigger. I push out when I would actually eventually pay tax. I lower my expected tax rate. Now here's the same thing with $3,000 interest. Now in this case, I actually make the students sit there with their calculator in the classroom and kind of grind through this, make sure they're understanding what we're doing. And it turns out the tax rate keeps falling, and now it's falling, because I made the loss even bigger still, I don't pay taxes now all the way till year 5. So each time I take more and more interest, I'm reducing my expected tax rate further and further, all right? So hopefully that was semi-clear, but if it wasn't, let's just think of it this way, by picture, okay? This is just a summary of no interest, 1,000 interest, 2,000, 3,000. I'm endogenously lowering my tax rate by taking on interest deductions each year. And the more debt I use, I reduce the value, the tax deduction value of the next tranche of debt that I would take on. So I'm kind of self-inflicting this declining marginal benefit function. All right? Now again, I'm going to talk about this in more general terms in just a minute. But the point here is supposed to be, to get them to really buy into the fact that a benefit function will be declining, in this case, just because of taxes. Okay? All right, so now I can come back to this picture that we talked about before, and I wanted to draw just the dotted line before. Remember when it was going linearly up? We have not introduced any costs yet, right? All we've done is said that the tax rate will fall as I use more debt. Meaning, remember the slope of this is the tax rate, so the slope of the value function will fall as I use more interest, right? That's why this is getting flatter. And when I push my tax rate all the way to 0, what that means is extra deductions don't buy me anything. I get no more value out of additional deductions. So this thing flattens out. So even without any costs, there's already kind of a logical stopping point. Well, if there was just an epsilon of cost, there's a logical stopping point here. Why go any further? I mean, you could technically in this scenario go further, but as soon as you start talking about cost, students are kind of already embraced. But the point here is that the benefits start declining, become less and less valuable, and we see that in this curve, the value curve that becomes flatter. Okay, well now it's time to talk about costs. And again, I'm sorry, I'm going to keep flying through it for a little bit, and then I'm going to finally kind of slow it down a little bit. But personal tax costs, bankruptcy, distress costs, agency costs, they're all costs we can consider. Okay, what about personal tax costs? The idea here, of course, just to go back all the way to Miller 77, is that because interest income is taxed at a higher rate for the investor than is equity income, the investor demands a higher return, a higher interest rate on debt relative to equity income if you could kind of control for risk. So because I had to pay more taxes on an investor, I make the company pay a higher interest rate. So because of personal taxes, investor taxes, it pushes up the cost of debt to the company. This offsets the tax benefit of debt. I put in the numbers for 2013. 43, so the rich, the wealthiest investors now actually pay tax on $1 of interest income, not counting state taxes, of 43 cents on the dollar now, because there's now this Medicare Affordable Care tax on top of a marginal tax rate as high as 39.6%. And equity taxes have jumped up to 20% plus this 3.8% passive income tax that got tacked on. So just remember though, the interest tax rate is higher than the equity tax rate still, okay? And therefore that's a sort of a disadvantage to having interest income. So I'm not gonna go through every bullet here, but this ultimately leads to this Merton-Miller formula here, okay? What we used to call T times D, tax rate times debt. Now this bracket replaces the corporate tax rate of 35%. And this bracket accounts for tax on equity income of about 24% now, tax on interest income of about 43%. Plug it into the formula, and we'll find out what this bracketed T is in just a minute, okay? But it's going to be smaller than 35%. There it is, it's 0.125%. So just because the personal tax penalty, if you buy into the assumptions behind where I got these numbers, you greatly reduce the tax benefit of debt right there. Now, I wouldn't get into it with students, but I was assuming the marginal investor is the highest tax rate investor. Not clear that that's the case, but assuming that, that's where I would have gotten those numbers. So typically, I kind of talk about the personal taxes and then just sort of say, set that aside. It's something to be aware of. But by the way, personal taxes, it's already impounded into market prices, right? We said that the interest rate on debt is higher because of personal taxes. So if I'm a manager and I look at my interest rate, well, it already includes any effects of personal taxes in there, so you don't really have to do as many explicit calculations as a manager. All right. So now, with that kind of like background, we're going to talk a little more conceptually, I guess, about how to think about how a firm should choose its debt. We talked about taxes are beneficial, personal taxes offset that some, but let's sort of walk through this. We're going to talk now basically about the costs that start offsetting the tax benefits or other benefits of debt. Okay. And this is where, actually I'm going to go ahead and talk about basically kind of like supply and demand curves here, but this is marginal benefit and marginal cost curves, all right? So we've already, here we've got a marginal benefit curve of debt and a marginal cost curve of debt. And in equilibrium, where marginal benefit equals marginal cost, that should tell you the optimal amount of debt, right? Why is that? And now, again, I apologize now, I'm going to start using occasionally some language that are used to the MBAs that I know. You already know this, but I guess I can't help myself. But let's say we were right here using this amount of debt. Well, by using one more dollar of debt, the benefit is much greater than the cost of that next benefit of debt, right? And so using another dollar debt, we're adding benefit greater than cost, benefit greater than cost. It's the forces of market of equilibrium are going to push us towards this amount of debt, right? If we use too much debt, now the costs are outstripping the benefits. Well, why don't I use a little less debt? Because I'm saving a lot of cost and not giving up much benefit, and that's going to push us back in this direction. So basically, we're going to kind of be pushed towards that optimal level. So why is it that the benefit function is downward sloping? So now we can either talk about, I can say, well, you already calculated that with your calculators. The tax benefit declines as you use more and more debt. That's why I took the time to do that before. Or you can make just a general argument. In economics, it's almost always the case that as you do more of something, the marginal benefit declines. Why do costs go up? Well, that one's actually kind of easier to talk about. It's just like bankruptcy costs. Everyone can kind of accept that as you use more debt, the expected bankruptcy cost will go up and up and up as I use more and more debt. And that'll give us the marginal benefit equals marginal cost point. So that might be one way to think about it. Another way to think about it would be this curve here. This is where I like to whip out my little thing, all right? Because it's awkward bringing this on the plane, but this is the way I do it with the MBA, so I brought it. So that was what we just talked about, marginal benefit equals marginal cost, right? Well, that point, that intersection point is exactly the same point where the total value function is at its peak, right? Why? Because when we start with no debt, remember, value of the unlevered firm, as I add debt, benefit is outstripping cost. I'm increasing total value, but at a decreasing rate, okay? That's why it's getting flatter. The benefit is just barely outstripping costs here. And when I get past that point, costs start outstripping benefits. That's going to push the curve down on the other side, right? So the marginal benefit equals marginal cost is the exact same point that this curve here peaks out, right? So as a student, for students, I'll say whatever way is more comfortable to you to think about, either way is fine. Just so you understand the idea here behind how you would kind of gravitate towards an optimal capital structure. Let me just go through this a little bit. Well, the third graph on here is the weighted average cost of capital formula. If you think of value equals cash flow over discount rate, like a perpetuity formula, if the discount rate is low, that's where value would be at its peak, right? So under certain conditions, you can think that the minimum point on WACC is the same point as the maximum point on these other two. So any one of those three ways works. And they're all kind of equivalent here, okay? In fact, here's JP Morgan. This is from this fall. This is what they go out to clients with. Now, I had debt on these axes, but as you use more debt, everything else equal, your credit rating will fall. So you can think of this as credit rating on the x-axis if you'd rather. And managers often do things in terms of credit ratings. So what JP Morgan does is they show as your credit rating gets worse, basically, at first the WACC function does decline, and then it starts to go up as you get into less highly rated debt. So for JP Morgan, kind of averaged across Fortune 500 companies, non-financial, they're saying the optimal credit rating is a BBB plus as of this fall. It varies depending on market interest rates and other conditions. Back in the financial crisis, you were falling off a cliff if you got down into junk rating, right? And so that pushed people to want to have less debt or a higher credit rating. But my real point here to the students is, I'm not just making this up. This is what JP Morgan does right here. And I'm telling you it's equivalent, so you can kind of think of it whichever way kind of works for you, all right? All right, then, again, my experience has been with students, the more you can convince them, you might actually do it on the job, like JP Morgan on the previous slide, or any company JP Morgan might come talk to, for example. CFO survey type evidence also can hammer home the point. So here's a survey we did. We asked companies, what are the key factors that affect your capital structure? What are the key drivers that affect your choice of capital structure? And here are the top 5 or 6, all right? I'm going to start with number 2 and circle back later to number 1. Well, the first thing, second thing that managers say affects their capital structure thinking is their credit rating. Well, guess what? That's what we just talked about with the JP Morgan picture, right? When managers say credit rating, we can immediately think, hey, our conceptual model here can handle credit ratings, right? So we can talk with managers. We can be part of that conversation through this model. Not only that, we can actually tell managers potentially what their optimal credit rating should be through this analysis here. Most companies will tell you what they want their credit rating to be, but if you push them, why is that optimal? They can't really tell you that. We can at least have the conversation. And by the way, I would never go into a company and tell them, you're wrong, your credit rating should be lower or higher, as much as say, okay, you said AA minus. Look, this analysis here, given these assumptions, says single A plus. Let's have a conversation about what the differences are, et cetera. But we can have the conversation because we understand where they're coming from. All right, earnings and cash flow volatility, right? That's some very important managers. So let's think of our little model here, right? And by the way, this is just the trade-off model, trade-off theory model, right? I haven't actually really used those words much yet, but when I eventually do use them, the students will be like, oh yeah, I got it, you already talked about this for half an hour, rather than hitting them with that up front. So we've got earnings and cash flow volatility. Well, what happens when your volatility goes up? Your costs go up. For every dollar of debt, it's going to be more costly if you have more volatile cash flow. So your costs go up, and guess what? Your optimal capital structure would go down. Makes total sense, right? I mean, we don't really need the picture, but the real point is we can take what managers say and easily think about it within this context, right? Interest tax savings, all right? Well, how would that show up? Well, let's say the corporate income tax rate went up. Well, that would mean for every dollar of debt, the benefit's higher for having interest deductions. That's like shifting up the benefit function. That means optimal amount of debt went up, right? So again, we can handle the conversation with management, at least in our heads, we can be thinking about these things with our model. So that is the, and I'll tell the students, this is the trade-off of trading off costs and benefits here, all right? And later in the class, I'll talk more formally about the trade-off, but just so you're familiar. Now, what about number one up here, right? Financial flexibility. Now, you all know what the pecking order model is and what it's built on, information asymmetry cost. We could actually walk through information asymmetry costs here, but rather than do that, I use it as an excuse to say, well, there's another way to think about capital structure, and that relates, that relates to information asymmetry costs. So, I mean, I'll give them the kind of simple version of the pecking order and ultimately conclude by saying the pecking order that managers prefer is they'd always rather use internal funds. If they have to use external, they'd rather use debt. And if they're running out of debt capacity, then they would switch to equity. And I would explain to them why through the pecking order logic. Well, financial flexibility, what that really means is preserve your debt capacity. Don't use it all up now, because when you need external financing, you want to be able to go out and get debt. So this pecking order kind of explains why financial flexibility is so important. And look at number 4, insufficient internal funds. I mean, that's straight out of the pecking order model. So I kind of set the stage now for when, in a few minutes, when I talk about those two theories more formally, you already understand it. And managers told us that's what they care about, right? So I've kind of bought the students in already. Okay, so that's kind of the conceptual framework. And it can be pretty fun. You can see light bulbs going off, and even the marketing students, the non-finance students sort of, I think, start getting this to some extent when they feel more comfortable with this. Well, now let's talk explicitly about costs. And now again, I'm going to flip through some of this a little more quickly for a few slides. By the way, I'm happy to share these slides with any of you. If you give me an email afterwards. And Jacqueline's taping this, so I guess it'll be online if you're interested in watching it again or something. I don't know. Anyway, bankruptcy costs, distress costs. What are bankruptcy and distress costs? Typically, I would have these blanked out, have the students tell me what they are. These are costs, and bankruptcy costs, are captured here. They're going up as I use more and more debt. The expected cost of these costs, like for example, not having suppliers wanting to supply you with products. As I get more and more debt, that's more likely to happen. That cost is greater. So I can capture the concept of bankruptcy costs, tie it into that cost curve. And then, I'm going to come back to my pictures. So I always like coming back to the pictures. And now what's happened, remember before we had any costs, the the total value function flattened out. Well, now that I have costs, guess what? Costs drive a wedge here. As I use very small amount of debt, the costs are small, but as I use more and more debt, it drives a bigger wedge. What that's going to do is make this thing have a peak point. So now I do have an explicit optimal amount of debt that I want to use, right? And that's balancing the costs and benefits of debt. Because I can do it with this middle picture, I could have done the same story with either of the other pictures, but I'm sticking with the middle picture for right now, okay? So bankruptcy costs push back against using too much debt. I mean, that's an intuitive idea, but now we've got it captured in the graph. then again, I'm not going to grind through this as much as show you. You can do some numerical examples to show them that if you could costlessly transfer wealth between bondholders and stockholders, you wouldn't shrink the size of the pie, and so value wouldn't be destroyed. It's really when you have these dead weight costs like lawyers' fees, that's when bankruptcy really starts shrinking the value of the pie. And so I'm going to show a numerical example to prove this. I'm just clicking through it now. But what ultimately happens is in the bad scenario, if lawyers' fees are 100, now in the bad scenario, bondholders only get 400 instead of the 500 they would have gotten without lawyers' costs. And that reduces the value of the bond to them, okay? And they're willing to pay here a smaller amount than they would have had that been 500 with no lawyers' fees, all right? And then here's the same kind of calculation for equity. Now what you can show here is, even though it looks like bondholders suffer, it's really the equity holders that suffer the cost. Why? Because bondholders are willing to pay them less principal. So remember how it works. Bondholders pay me the principal, I'm the equity holder, I put that in my pocket, and I still have what's left over. Well, now I have less to put in my pocket, because bondholders anticipate the lawyer's fees, so the equity holder, because they have less in their pocket, they're actually the ones that kind of suffer the cost. So that's bankruptcy cost. Here's a homework problem that we have in our set that, marginal benefit equals marginal cost, or maximize total value. They kind of numerically do a problem like that. Okay, another kind of cost, agency cost, right? So when debt exists, there can be other distortions and costs that come about, which of course we call agency costs. We've been assuming that we could have perfect costless covenants that would prohibit agency costs or something up to this point. But now we're going to acknowledge there can be agency costs. So if bondholders are able to issue debt that's senior, if equity holders are able to issue debt that's senior to the existing bonds, like in an LBO, which sometimes happens that way, that's going to reduce the value of the existing bondholders to the benefit of equity holders, right? So that would bring about an agency cost that bondholders wouldn't like. They might not pay as much for those bonds. We could also have overinvestment where equity holders, because debt exists, equity holders now have incentive to take on riskier projects and overinvest in them. Or underinvestment, because debt exists, because the company's using some debt, now the firm might pass up some positive net present value projects because that value would have gone to kind of shore up the bonds, and equity holders at times will say, I don't want to bother with that, I'm going to pass up the project. So I'm going to go through examples of those to kind of show them that overinvestment costs, again, it's not just pure academics. These things do happen when a fair amount of debt exists under distress type situations. And I can show you might overinvest in a risky negative net present value project, or underinvest by passing up positive net present value projects, and just kind of showing numerical examples there. Well, if bondholders know what's happening, they're going to try to put a bunch of constraints and covenants to restrict equity holders ex ante, right? They're not going to just sit there and take it. They're going to pay less up front, or they're going to put covenants on that restrict the operations of the firm to be suboptimal. So ex ante, these costs are going to be a cost that are going to be borne by the firm, even if we never get to the point where those agency over or under investment were to occur. So again, I went fast through that, but picture-wise, what's going on is we now have another wedge that shows up, where now this was with just bankruptcy costs, and now we've got here with agency costs are going to drive another wedge here, okay? Meaning that when you add agency costs, this function is actually going to peak out even further this way. In other words, the optimal amount of debt gets smaller once we introduce agency costs relative to a world without agency costs, okay? And so again, because we kind of made them comfortable with the pictures at first, then it hopefully is kind of still working to kind of convince them these costs push back on the amount of debt you may use. All right, so one thing I like to do with the students is occasionally pause and make them kind of tell me what we just went over, right? Sometimes the next day at the beginning of class, sometimes towards the end of class. And so I have this like little quiz game thing I play with them, and I take the left, the middle, and the right part of the class and have them play against each other or something and keep tallies through the year. So here we could ask about why was that dotted line straight with a slope of 35%? We just talked about it, but make the MBA students tell me this function here, what's going on here, what happens with personal taxes, why does that reduce the tax benefits of debt? And then here's one we actually hadn't talked about yet to kind of make them stretch a little bit. That blue agency curve from the previous graph, it turns out there are actually agency benefits of debt. Don't worry, Jacqueline, I'll stay over here. When you first start using a little bit of debt, it actually can put some discipline on a company through running a tight ship or closely monitoring the company, debt holders might, or bank bonds, banks or other debt holders might closely monitor the firm. So using debt can actually have an agency benefit that might actually push the benefit up above just the pure tax benefits. So I'm trying to introduce the idea here that there are other benefits to debt, not just tax benefits, okay? So if we don't introduce that and Congress takes away tax deductibility, what are we going to do, right? We need to have some other benefits mixed in there. Anyway, I'll try to get that out of in the last bullet point. Not too many students will get that one right until we talk about it. Related thing I like to try to do is talk about job interview questions, right, sort of throughout the class. Because again, MBA student, does it matter to my professional life or my personal life? Well, if I might get asked a job interview question related, it matters to me. I better perk up and pay attention. Or if I'm reading a textbook and this is out in the margin, I better really read that page, and if I need to, go back and read it again because it's important to me. And these are typically actual job interview questions that kind of keep gathering every year from the students, what they ask you in their job interviews, and I take them and collect them and use those as a motivational tool. I mean, MBAs can have a tendency to think, I keep saying MBAs, and I think undergrads it applies to also, although maybe not quite as much. Sometimes I think they think what we teach them in the classroom is just whatever, I'm going to learn on the job what I really need to learn. But it's not like they invented a whole new finance in the real world that we don't know about, right? And so it's a matter of kind of convincing them this is the fundamentals of what you will learn. You might use different words and put some new wrinkles on it, but I want to kind of convince them what we're doing in the classroom is, in fact, the fundamentals they need for their future career. You ready here? Oh, ready? Not quite, but just about. So now, finally, I'm going to say, okay, we've been talking about the trade-off theory of capital structure, and I'm finally going to kind of formally define it. And I'm going to say this was just trading off benefits and costs to find an optimum. We'll talk more formally about it now, but by now, I've disarmed them. If I put this up first, then a lot of students will put up the barriers, it's theory, it's not practical, it's not going to affect you, right? But I've already kind of tried to show them through all kinds of different pictures and examples. Makes total sense. CFOs say stuff that basically justifies the trade-off theory, okay? So I won't read all those things, but we do have the benefits tax, bank monitoring, running tight ship, bankruptcy, agency costs, etc. One of the predictions of the trade-off theory is a target debt ratio, optimal amount of debt. What do managers say about that? Well, here's a survey from Survey and Tufano that argues that 60, 70, 80% of managers say, yes, we have a target debt ratio. Now, there are other surveys that might argue that it's a flexible target, right? This might overstate it a little bit. Depending on how you want to go with that, you kind of put up a different picture here. But it does look like around the world, the concept of a target is pretty widely accepted. Maybe it's a matter of how rigid that target is. But again, that kind of is a good thing to reinforce that CFOs kind of agree with that prediction from trade-off. Then talk a little about empirical evidence. Yes, higher tax rate firms use more debt. Yes, firms with more collateral use more debt. Well, if you have more collateral, typically that lowers the cost function, right? Use more debt, right? That's what the empirical evidence says. Firms that are not growth firms, so mature firms use more debt. I won't hold up the picture, but you kind of get the idea. The one real test or difficulty for the static trade-off theory, at least, is why do profitable firms borrow less? Because we think profitable firms have a really high tax rate, we should borrow more. Well, they borrow less. And guess what? We already talked about that too, the pecking order. So again, it's not now I'm just loading on these theories. It's more like, hey, we already talked about this. Remember, CFOs kind of tell us stuff that justifies us believing that this is a valid way to think about things. Okay, so there's pecking order. Talk about that. Yes, internal funds are really important for investment, just like the pecking order would say they should be. Okay, so now, summary again. Try to make the students tell me what we learned rather than me quickly, ding, 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 we're done. Just a review, we talked about, I'm not going to do it here. And then I'm going to say, wouldn't it be nice if we actually could estimate this for any given firm? Wouldn't it be nice if we could actually estimate, when I'm saying this, I better show it for Jacqueline's camera. Jacqueline, wouldn't it be nice if we could estimate the benefit function for any given firm, or the cost function for any given firm, okay? Guess what? We actually can. And in fact, you already did the benefit function with your calculator, right? Tell the students. So now we're going to kind of move into, now this is where we're really getting kind of closer to research, but this is where we can kind of apply these concepts in a way that you literally can do it in Excel. I couldn't do it on the MacBook Air in Excel, it turned out. Well, I think this guy's going to save the day here in just a minute. So let's talk about some, before we get to the Excel sheet. Here's a company, Altel, 2006. This is their tax benefit function of debt. How did I estimate that? Well, I just said, well, if they didn't have any debt at all, their tax rate would be 35%, just like that problem we did a while ago, okay? As they add interest, they're going to be deducting the interest, reducing their taxable income. Eventually, they're going to put so much taxable, or they're going to reduce taxable income so much that they're actually going to become non-taxable in some scenarios, right? Because of that, their expected tax rate will fall, even when you consider carry-forwards and carrybacks. Eventually, that will happen. Then the function becomes downward sloping, like the example you calculated with your calculators. And eventually, if you go far enough, it would go all the way to 0. Eventually, you would have so many deductions that in every scenario, another dollar of interest isn't going to do you any good because you're not paying taxes in any scenario. And your tax rate's 0, and the incremental benefit of any more debt is also 0. So that you can do. In fact, I put these slides back in here. You already did that with your calculator, right? So accept the fact, all I did was write a little computer program that does it for any given company, considering carry-forwards and carrybacks, okay? All right, so if I can do that for any given company, that's the benefit function, let's say for Altel that I just calculated. Let's say I did that for several years for Altel, and its benefit function kind of moves around, maybe as the tax rate changes, okay? Well, guess what? What do we know from what we talked about so far? We know the benefit function will be downward sloping, and we can calculate that with our calculator potentially. We also know that the company's always going to choose marginal benefit equals marginal cost. We know if we're finding companies that are making optimal choices, the amount of debt they choose in this year, as marked by this circle, should be where marginal benefit equals marginal cost. So even though I haven't explicitly calculated the marginal cost curve, I do know it must cut the benefit function here. And likewise, in the next year, it must cut the benefit function here, because I know the intersection points, all right? So what we need is a situation where the cost function is not shifting around, it's being held constant, and the benefit function is moving. That allows us, using academic lingo, to identify the cost function, right? And so what we're gonna do in this little research paper, I had to read the JACF version of it first, is go down to a subset of firms that we think are probably making close to optimal choices because they recently did a decent sized capital structure transaction. And we're gonna, just on those firms, try to back out what the cost function must be. I'll talk more about that in just a minute, all right? Once I have a cost function and benefit function, then I'm all set, all right? Here, for example, is Burlington Coat Factory Warehouse. Burlington is very near Duke, so use this example, pretty old example by now, but Tax Reform Act of '86. The tax rate was cut in 2 steps, and guess what? Burlington reduced their amount of debt over those years where the tax rate was cut. So, we can kind of back out that the cost function probably looks something like that dotted line, given the shifting benefit function and the actual debt choices they made, okay? Now, pictures are nice, but if you're going to do this for a whole bunch of companies, you don't actually just look at a bunch of pictures and draw a dotted line. We're going to actually use a regression. Now this is where, as academics, you got it. For the students, you do have to kind of bring them along a little bit here and just say, look, we're going to run a regression that is going to account for the shifts in the benefit function while holding the cost function constant. And when I do that, I'm going to be able to estimate the cost of debt as a function of these firm characteristics. So the first one is dollars of interest, or just think of it as debt. Because that's positive, all that means is there's a positive marginal benefit to using debt, kind of that tax deduction thing we talked about, all right? Well, I mean, that's the benefit, excuse me. The cost, it goes up. I said that wrong. As you use more debt, the cost goes up, positive slope, because bankruptcy costs are going to go up. So there's a positive relation between costs as you use more and more debt at marginal cost, okay? What else do we have? Collateral, right? That has a negative sign on it. What that means is the costs of debt go down for a firm with more collateral. Costs go down, it means you use more debt. Let me show you the next picture and I'll come back. That's literally the cost function for a low collateral and a high collateral firm. It does shift down. And likewise, you can see, mature firms, so non-growth firms, there's a negative relation here. The cost goes down for mature firms. So what this means is we can run a statistical regression and estimate what the cost function must be for a firm and give me values for those 6 or 7 variables on the right-hand side, plug them in, and I can estimate the cost function, give us assumptions for any firm, right? There's other versions of that where we throw in some macroeconomic effects and everything, but that's the basic idea. We look at firms that we feel comfortable they're making equilibrium choices, estimate a regression, and use those estimated parameters to plug in values for other firms that may or may not be making optimal choices, but we can get a cost curve estimate from them. And once I have the cost curve, then I can estimate benefits. For any company, I can directly simulate the benefit function just by doing that tax stuff we talked about before. Now I can use a regression to kind of back into what the cost function must be, just by plugging in company characteristics and multiplying by estimated parameters, okay? So for example, there's Office Depot 2006, okay? So I plugged in the values for those 5 or 6, 7 variables for Office Depot, and this shows me how their cost function increases as I use more debt, okay? This is the same cost function for Office Depot, but now I do a benefit function. Where did I get that? Well, I simulated that directly by doing, again, the same. This is like the flat part of their benefit function. It would eventually become downward sloping. The same calculation we did with our calculators, all right? So what this means is, according to this model, for firms that have characteristics like Office Depot, they should choose where marginal cost equals marginal benefit. That's their optimal amount of debt, that dotted line, according to this model for firms with characteristics like Office Depot. Well, how much debt did they actually use? Basically, almost that exact correct amount. So who would have known it? But Office Depot actually, at least in 2006, had close to optimal capital structure. Now, estimating the benefit and cost functions is cool, but we can also say, what's the value, what's the benefit for having chosen the correct capital structure? It's just this gray area here. Integrate between the curves, or for the students, add up the area of that triangle, and that'll tell me what the benefit of optimal capital structure is for Office Depot in that year. That's only 1 year, 2006, divided by R, turn it into perpetuity. That gives you a sense of the value if they take the optimal choice every year. 4.5% of value for Office Depot comes from making optimal capital structure choice, okay? That's tax benefits, other benefits of debt, net of costs, okay? Is that a big number or a small number? You tell me, right? I'd say it's a medium-sized number. But as much as anything, it's a number I could have a conversation now with management there, or they could if they worked there, or they're an investment banker or whatever, and start the conversation, right? Not every firm is close to optimal. Here's Six Flags, used to be Six Flags over Georgia, now Six Flags. Their benefit functions here the cost function for Six Flags is here. So for companies that have characteristics like Six Flags, this would be their cost function. Marginal benefit equals marginal cost. That's how much debt they should have. They had 3 times as much debt as they should have, okay? Well, whoops, area B up there is an estimate of where costs are outstripping benefits. 14% of firm value they're destroying on an ex-ante basis because they have too much debt, okay? I would have loved to have gone in and talked to these guys and said, what are you doing? Well, what they did with the debt, by the way, is they built a bunch of amusement park. Happened to be right before the recession. It was pretty bad all around. But even before we knew the recession was coming, we could have said, you better have a darn good operating plan to justify burning up 14% of firm value from your capital structure choice, right? Now, it goes the other way sometimes. Here's Performance Food Group. Here's their benefit function. Again, I simulate that directly. Estimate the cost function for firms like that have characteristics like this company. This would be their cost function. Model says marginal benefit equals marginal cost. That's how much debt they should have. Well, they only had that much debt. They had only about 1/3 of what they should have had. Does that matter? Is that important? Well, what they're passing up is area B here, where benefit would have outstripped cost. That whole light gray area, that's about 7% of firm value. That's about 4%. They could have had 11% of firm value from optimal capital structure, but they were passing up area B, which is about 7%, okay? Again, you know, I want to at least be able to talk to the management and say, are you aware of this? Why are you doing it? They may be perfectly content with what they're doing. We might not change their opinion, but now we can at least have a conversation and put numbers to it, okay? So happens that Performance Food Group did an LBO the next year and happened to lever up to almost that exact spot, okay? That's coincidental. We had actually picked this example out before I knew that. All right, can we give it a shot here? So you can actually, okay, so for example, here's Eli Lilly, all right? Here's their data, their credit rating is AA minus, and here's just data on their assets and interest expense, et cetera. Some of the right-hand side variables, plus a few other things that we plug in. In this spreadsheet, if you hit that optimal capital structure button, what'll happen is it'll produce these numbers here. And on the top here, this little group here, it'll tell us, well, let's look at the picture first. According to the model, the Excel literally directly simulates a benefit function. We don't have the part where it's downward sloping shown. It estimates the cost function given those characteristics. They're pretty darn close, right? The model says they should have this much debt. They have that much debt. That little triangle right there is the value they're giving up by not being optimal. Eli Lilly, it's like 0.1% of firm value. So they're effectively correctly levered, okay? If you look down here, it'll have the other two pictures also. The total value function in red and the weighted average cost of capital in blue. And it'll show you that, even if they used a little more debt, they're on a pretty flat part of their functions here. They could go a little bit either way and it wouldn't really affect value very much, okay? So that's for a company that's doing kind of the correct choice, if you will. Let's put another company in there that looks like they're overdoing with leverage. So this is Health South Healthcare Company. All we're going to do is plug their data in over here, hit the optimal capital structure button, and let the spreadsheet kind of do its work. And you can see it's already done. And what we've got here, these guys are over-levered, okay? The model says marginal benefit equals marginal cost. They should be here. They're actually here. So this is a bigger triangle now that they're giving up in value for this year. That's about 4% of firm value. And if you look at those pictures down lower, you can see again, they're actually closer now to being, they are past the peak in value. This is the total value function, the middle of those three graphs, past the peak. Likewise for weighted average cost of capital, but they're not too far past. They're like 4% of firm value past. Let's say these guys went kind of nuts here and doubled their amount of interest. So we come up here, and rather than 126 million in interest, holding everything else constant, which is probably a little bit of a stretch, but let's put them up to 250 in interest now. Okay. Hit optimal capital structure button. Well, now look what's happened. They're burning through 28% of firm value now. So if they were foolish enough to go that far with their capital structure, they would really they'd be ahead of Six Flags here in terms of burning value. And you can see what's happened is they've moved well past the peak point in value, total value, and well past the minimum weighted average cost of capital. So you can see that taking these sort of abstract concepts and pictures, but knowing how to simulate that directly and back out the cost curve, we can actually kind of ram it all into Excel. And even for the students who will never want to use the spread, I mean, the investment bankers want to get a hold of the spreadsheet. Some of the other students maybe don't want to do that, but it validates to them what we've been doing, that they could actually estimate that for a real world company. So it wasn't just a bunch of hokey academic stuff. The academic stuff is actually the underpinnings of what you could do in the real world. I don't have another JP Morgan graph for you, but ultimately that's what either JP Morgan's doing some version of this, or they're somehow waving their arms around to come up with some other softer version. But it is a approach you could potentially use in the real world. So I'm going to say just a couple more things, and then I'll stop. If you did that for every public company in the U.S., in other words, CompuStat, and sorted them by benefit, so this is the top 5% of companies here, benefits for those companies and costs for those companies, about 11% of firm value is being created for them by optimal capital structure. So 1 out of every 20 companies. For the next 1 out of every 20, it's about 8% benefits outstripping cost. For roughly half of companies, it looks like there's benefit being created by optimal capital structure worth paying attention to. For the other half, it's really not, right? There are some companies where, like I didn't show you Exxon, they were in that little spreadsheet, but with Exxon, they're making so close to optimal, and they're worth so much outside of any kind of capital structure, it's just a drop in the bucket, right? Not that they should do stupid things with capital structure, but they probably don't need to focus on that for the company. This now is based just on the cost part, not the net benefit or anything. We see for deviations from optimal, how much the cost is going up for being over-levered or being under-levered. What you can get from this picture is it's asymmetric. The costs of being over-levered are greater than the cost of being under-levered, okay? That might be one reason why companies have a tendency to remain under-levered. What we think they should be, what the model says, or what we would say their leverage should be, they're a little under-levered, maybe because they're staying away from this asymmetrically higher cost. One thing I didn't say before, so when I estimated the cost thing, remember I ran a regression and backed out a cost function, got parameters that they're out there in the article, anyone could use them. Another way you could have done it is done something with just default probabilities and estimated the cost of default. So for example, Almeida and Philippon do that in their very nice Journal of Finance article, right? And they show for AAA, AA, single A, et cetera companies, default costs given default go up as your credit rating goes down, right? As your amount of debt usage goes up. Well, our cost function is actually a kind of an all-in cost. It includes default costs, but it also includes whatever other costs, maybe agency costs. It's roughly twice as high for any given credit rating. I learned something when we first produced this. I had no idea that agency costs might be of the same magnitude as default costs. Another way to say it, though, is if you only use the default costs, then you're kind of underestimating the cost of using debt. And if you underestimate the cost of using debt, you're going to think the optimal amount of debt is higher than it really is. Okay? So that's something to keep in mind. One advantage of kind of considering this all-in ex-ante cost of debt. This here is just showing students, that was a conceptual, pretty-looking picture. But if we just estimate this stuff for every company, we can estimate the light gray line is for the upper half of companies. They add about 6% of firm value above what the unlevered firm would be by using optimal capital structure. And then I think this will be the last graph I show. This is that same graph for performance food group. Remember before we had the light gray triangle? This is just showing it, that was the marginal benefit, marginal cost. Here it is for the total benefit function, where we showed they were operating here. If they chose optimal, they could add about roughly another 7% to firm value. And when they chose their capital structure, they actually pretty much hit the peak on the head. One other thing you get out of this, it is kind of flat up here, right? We often wonder why capital structure research is a bit challenging. Well, one reason might be that the value function is kind of flat. So you can kind of deviate within plus or minus 20% without burning much value. And so that's going to put a lot of noise into our empirical work. So anyway, that's ultimately the way I would teach capital structure over at Fuqua. And it started with basic stuff, Miller benefit cost functions, but ultimately building up to actually being able to kind of implement that with real world data. And overall, it seems like the students kind of buy into the whole exercise more because we end up with the real world data. Anybody have a question or anything? Yep.